Hi, my name is John Ciampoli, and I am the author of the Champs Forecast Get the Economic Edge newsletter. We are off to what's going to be one hell of a year, whether you realize it or not. We are currently at the tipping point of a 46-year Ponzi scheme known as the unbacked greenback, a fiat currency backed by nothing other than oil, military might, tradition, and a lack of a substitute currency. All since Nixon famously took us off the gold standard in 1971. One thing to keep in mind, the dollar is not in the purest definition money. It is simply a means of exchange, but not a store of value. Please look at this chart. It shows the incredible depreciation of the US dollar over the first 100 years since the creation of the Federal Reserve in 1913 up until 2013. You can see all the events that have happened and the absolute depreciation. Basically, the dollar right now is worth 5 cents of what it used to be. So what is the point of this newsletter and what benefits will you gain from reading this? Well, my writing is a combination of some of the greatest modern financial and geopolitical minds of the 21st century. I've been following them avidly for the past 6 years, day and night, studying their commentary, interviews, and writings, all for one aim: to better my lot in life, to better be able to serve life's calling to become great and accomplish great things, to break the paycheck to paycheck cycle and enter one of prosperity is the aim which I hope to share with you. Now, although this newsletter is designed for those who have still not yet reached their desired level of financial prosperity, it can certainly help you, even if you are financially prosperous, to gain a better understanding of our economic world, the current driving forces at play, both political and economic, and the major transition about to unfold, one which will shake the very core of the financial system. Many will lose all they have and in fact be thrown into debt when the next shift in the current financial system takes place. Others will gain massive wealth because they knew it was coming and prepared accordingly. It is up to you as to which side of the canyon you wish to be on. On to what is coming. The greatest wealth transfer in the history of the world. There are two things you need to do right now in order to benefit from the coming shift from paper assets to physical assets, which will transpire within the next 6 to 18 months. 1. Get out of paper assets. That's equities, bonds, and other fiat currency options. Paper is not the place to be in this upcoming shift. 2. Get into physical assets, namely gold and even more so, physical silver. Nothing in the world, in my opinion, will revalue in such a dramatic way than physical silver over the next 18 months, perhaps even much sooner. Currently, the price of silver, and gold of course, is set by the COMEX, the Commodity Exchange Incorporated, part of the New York Mercantile Exchange NYMEX, and the LBMA, the London Bullion Market Association. These are two paper markets, which means physical metal does not exchange hands when one buys or sells gold or silver contracts on these markets. They merely swap paper promises back and forth. Delivery of physical metal is rarely taken, and when it is requested, rarely, the exchanges usually try to offer cash in exchange for the paper contract. Anything to avoid delivering the actual metal, which is in very, very short supply. According to Eric Sprott, YouTube him now if you have not heard of him before, they exchange up to 1 billion ounces a day in silver in paper contracts on these markets. Meanwhile, there are only 1 million physical ounces available on a given day for investment purposes. Much of silver, physically, is consumed by industry for its multitude of purposes, from solar, technology, biomedical, and even bacteria-resistant clothing. Please watch Top 14 Reasons to Buy Silver on YouTube. This video will blow your mind. So what does this mean for you personally, and what opportunity does this information present, you might be asking? Well, one of the greatest investment opportunities for the average person in the history of the world. Think about it. A paper market that is so distorted it trades 300 to 400 times the paper than there is actual physical metal. So is the real physical price, apart from this paper Ponzi scheme market, supposed to be 300 to 400 times higher than its current price? Yes. Loudly and clearly, yes. Even higher, as you will find out later in this newsletter. And just think, right now, you can go into your local coin shop and get 1 ounce of silver for $20. Not a bad deal, eh? So what do you need to do to benefit directly from this? Well, one is to buy physical silver. Period. Yes, that's simple. Sometimes in life, some of the greatest opportunities are simple and straightforward by their very nature, if you understand and are aware of the driving forces behind them. Just think about if one understood the power of the automobile or the internet to revolutionize the worlds of transport and the exchange of information before they actually took off. Well, I suppose someone might sell all they own, assets, retirement accounts, stocks, you name it, to invest in either of those opportunities. If this makes you think, well, the dot-com bubble popped, you are right. But before that, many millionaires were made and knew to get out before it popped. The smart money, those that do their research and are consistently learning about new opportunities, get out before the bubble pops. Now it is your time to get out of the paper asset bubble and into the next wave of incredible gain, the physical gold and silver markets. Back to the basics on how to benefit from what is coming in our financial world. First, get out of paper assets. What does this mean practically? As crazy as it may sound, it means to divest your investment portfolio out of the paper Ponzi scheme. Get out of your Roth IRA, your 401k, out of your savings bonds, out of T-bills, out of paper contracts for precious metals. Get out now. Notice I said paper contracts. You want to be in physical assets. I mean literally cashing out your retirement plan because it is headed for a crash. It will be so devalued when the propped up quantitative easing equities bubble explodes, it will be worth a fraction of where it currently sits. When, not if, the equity market crashes, your entire portfolio will be cut down to near nothing. Get out now before it's too late and you are left with only a percentage of your current portfolio. Why? Why is all of this about to unfold? The two best economic analysts to answer the why question, in my opinion, are Mike Maloney and Porter Stansberry. All you need to do is YouTube either of those gentlemen to find out the logic behind the why. The answer? It's cyclical. Yes, it's that simple. Throughout history, there have been major shifts from one world reserve currency, or the predominant currency all others are measured by, to another. This time, however, is different. Unlike previous monetary transition periods from one reserve currency to another, this time there is no currency immediately available to take the dollar's place. We are over the 94-year average that it takes to pass from one reserve currency to another, currently in year 96. We took Britain's place in 1921, when we were a nation of builders and producers and had a currency backed by real money, namely gold and silver. Now we are about to be overtaken by China and Russia, who have been hoarding gold and silver, importing as much as they reasonably can, but they are not quite ready to slip into the world's reserve currency status. They need two things: time and a crisis. The time is almost at hand, as is the crisis: the crash of the US dollar. This chart shows the global reserve currencies since 1450. As you can see, on average, every 94 years there is a major shift in the world reserve currency. Currently, we are in year 96. We are at the tipping point of a cyclical change. At present, there are 101 triggers which can set off the next economic collapse, the foremost being a possible rise in interest rates. And amazingly, the Fed has stated that there will be at least 3 rate hikes in 2017. This could undoubtedly kick off the next economic crash. The balance of debts to assets is epically overblown throughout the global economy, and national debt loads are at record levels. As I write this newsletter, the global debt clock is over $62 trillion. Every nation's currency is debt-backed fiat, meaning it is not backed by real money, gold or silver. This has never been the case in recorded history. Interest rates. The derivatives market lives largely behind the shadows, one in which your average investor does not understand or is allowed to enter into. Their creators are the financial insiders, the day traders, the brokerage houses of debauchery. In straight talk, what are derivatives? They are simply contracts. The complicated part is that derivatives are financial agreements or bets, which spin off of other agreements, which spin off of other agreements, etc., endlessly going down a rabbit hole of bets or contracts. Here's an example. If John has a portfolio of high-risk, mortgage-backed securities and wants to hedge his bet because he fears another housing crash, he can draw up an agreement with Dave. Dave agrees to assume part of the risk if the mortgage bonds fail, say 15%, for a premium to be paid to him monthly for assuming part of the risk. Dave later thinks, maybe I can also find someone to either hedge my own bet in case the housing market does crash, or I can increase my position and find another sucker who thinks the housing market will crash again. Whatever Dave feels that day. Then he in turn makes an agreement with Pete, offers a percentage of the risk on his current bet with John for a premium and a stream of some of the income. So on and on it goes, like a merry-go-round built on a spinning top. Eventually, the top will stop spinning, and all the king's horses won't be able to put John, Dave, and Pete back together again. Being that some derivatives are related to the housing market, some equities, many are based on interest rates, others are based on whatever can be dreamed up to place a wager on. Which company will fail, will the Thai baht crash, etc. Gyrations in any of the real markets, housing, equities, and especially interest rate-based entities can adversely affect the derivatives market, which is said to be over $1 quadrillion in total exposure. 1 quadrillion. This could cause a collapse large enough to take down the real economy. Time is closing in on the derivatives time bomb. Once it goes, so goes the global economy. The largest portion of the derivatives world are interest rate-based bets. Nothing which is artificially priced, such as the current interest rates set by the Fed, will last forever. We currently stand at the precipice of rising rates, as stated by the Fed, and once they do, 2 things will happen. 1, we will not be able to service the national debt, and 2, the derivatives market will blow. So what, you may ask, is the opportunity that is currently presenting itself? How does knowing about this coming economic storm benefit me? Should we all just crawl into a bunker and call it quits? No. You will prosper knowing what is coming if you take action. More millionaires were made during the Great Depression than at any other time in history. Why? Because they saw what was coming and they knew what action to take. There were plenty of investment opportunities to those who paid attention. Now is the time to act. Get out of paper assets. They will be worth very little very soon. What pool do I jump into, you ask? Now that we are jumping out of the soon-to-be worthless paper assets, what then do we dive into? Simply put, physical assets. Normally, physical assets would include anything tangible, most all commodities and real estate. However, this time will be very different and the margin of error will be even smaller. This time, real estate will not immediately be the asset to jump into, at least not right now, especially if you are talking about real estate in major cities. Most real estate markets in the US are still highly inflated, all because when the previous real estate bubble popped in 2007 and 2008, the Federal Reserve famously stepped in and reinflated it with what they called quantitative easing, also known as money printing, although it was actually done digitally. This digital currency they created out of thin air served to prop up the housing markets, which is where they still sit. But not for long. Take a look at this chart from the Fed St. Louis. It shows the massive money printing which took place in order to prop up both the equity and housing markets after the 2007 and 2008 housing crash. You can see the money supply went from 900 billion to 4.2 trillion dollars, a 355% increase in the total monetary base in 5 years. This is unheard of. The only reason this has not yet caused a hyperinflation is because many of the major banks that were lent this money did not loan it into the public. They did not loan it out to Main Street. They kept it on their books to help them appear solvent at a time when banks were being stress tested and probed. So there it sat on their books, dormant and waiting. It simply sat there. Because of this, right now we face two possible outcomes. Either economic activity picks up and the stored up money is unleashed onto Main Street, resulting in inflation leading to a hyperinflation, or a black swan in either real estate, stocks, or the derivatives market occurs, resulting in a crash so catastrophic that it wipes out the money supply with it. Either will cause total economic devastation. So if you can't jump into real estate, equities are dicey and are about to implode, and T-bills and bonds are about to default, where do you go? Answer: into physical gold and silver. While gold and silver are the safest, most reliable, history-proven assets that exist, some of my online mentors whom I research and follow, great men such as Jeff Berwick, are advocates of Bitcoin and other similar digital currencies as a competing asset to gold and silver. I am not that adventurous and am more in line with the thinking of Jim Sinclair in that they are also unbacked forms of currency. They are not part of the current financial system run by the world's cabal of central bankers. But because digital currencies are not historically proven, I cannot with any certainty advocate investing most or all of your portfolio into them. Gold and silver have 6,000 years of history in which thousands of fiat currencies have gone to zero, and these metals have maintained and actually increased in purchasing power. I do, however, advocate picking up some Bitcoin if you have some extra fiat currency to invest, only after buying a comfortable amount of silver and or gold if you can afford it. Anything that goes from $3 to $1,000 in less than a decade obviously has some upside potential. Some are even saying China will soon be getting behind digital currency exchanges and will facilitate their population's use of the digital currency as a medium of exchange. Either way, it's on my radar, but I just do not completely trust it and cannot, with great confidence, rely on a future lasting upside. Back to the physical. As Mike Maloney says, if you can't hold it, you don't own it. The only assets, in my opinion, worth investing in, whose values are not dependent upon another entity fulfilling a promise, are gold and silver. I do not mean buying mining shares or the ETF versions such as GLD or SLV. I do mean going to one of the reputable online dealers or even down to your local reputable coin shop and buying physical coins and bullion. Not collector coins with a specially assigned value, but bullion-based ounces. All that will matter at the end of this economic implosion is how many ounces you have, not what year or style the coin is. It would do you quite well to watch Mike Maloney's The Case for $20,000 an Ounce Gold Debt Collapse video, which is on YouTube. He clearly spells out the cyclical nature to investing and the asset groups that are currently in play. how there is a natural ebb and flow between asset groups. One becomes overvalued and another undervalued. A constant transfer from undervalued to overvalued to undervalued and so on. It's an amazing video and will fill in the details as to why you should jump into the gold and silver pool. And for most, just the silver pool. Gold is a bit too expensive for the common man. And percentage-wise, silver will do better in the next economic collapse as it closes in on the more historical 16-to-1 ratio between silver and gold. That is the ratio that silver to gold is taken out of the ground. Currently, it stands at a 71-to-1 ratio, silver to gold. And as Mike Maloney says, it will actually overshoot. I would say silver will rise to at least a 5-to-1 ratio compared with gold. This also corresponds with the paper fraud of the COMEX and LBMA, which trade paper contracts at a reported 300 to 400 times the actual physical supply of the stored metals. Accounting for this massive naked short selling, paper fraud, in the precious metals markets, I calculate taking the middle road of 350 times $17, the current price of an ounce of silver, you come up with a figure of $5,950 an ounce. Not done yet though. That is only if the current precious metals market remains the same size in terms of number of participants. Anytime there is a once-in-a-lifetime bull market in a given sector, you can expect at least 3 to 4 times the number of additional investors to jump into the market once the bull has taken off. That brings our final figure for 1 ounce of silver in today's terms to $17,850 to around $23,800 an ounce. Keep in mind, this is while retirement accounts will be evaporating, equities crashing, and the housing market drops at least 50% nominally because they are in current bubbles. Thus, multiply your $17,850 to $23,800 an ounce silver by 2 or 3-fold to get the actual purchasing power. At the peak of the coming precious metals mania, as little as 5 ounces of silver will be able to buy a median-priced house. What newsletter would be complete without predictions of some sort or another? However, guessing the exact timing on such events as a catastrophic market collapse in almost all sectors is a near impossibility. Some have nailed it dead on, such as Martin Armstrong and the 1987 stock market crash. He actually took out a full-page article in the newspaper predicting it. If you have not heard of Martin Armstrong before and are not familiar with his work, please check it out. His work is absolutely mind-blowing. He relates pi, 3.14, to cycles in the economy and geopolitical events. The results are incredible. Although I am fascinated with Armstrong, I do not dabble in selecting particular dates for economic predictions. I would rather give a time frame to be ready and invested by. Luckily, as of right now, February 2017, there is still time to buy physical gold and silver bullion. But do not wait too long. Within the next 6 to 18 months, the inevitable economic collapse that some have been expecting will take place. This will leave most with little to nothing in terms of assets and savings. They will only have the physical possessions they own outright. The most direct and efficient way, not only to protect but actually grow your wealth, is to invest and take possession of physical gold and silver. Prediction number 2. By August of 2017, one or a few of the major European banks will fail. Here are the leading candidates. Deutsche Bank of Germany. They have over $47 trillion in derivatives exposure. This is absolutely unheard of. This chart shows the connectedness of Deutsche Bank to all the major banks in the world. They are truly connected to the entire global financial system. The second bank on my radar is Banco BPM of Italy. This bank is the Frankenstein result of merging two insolvent major Italian banks, Banco Popolare and Popolare di Milano. Both were about to fail and then merged together to create this Frankenstein known as Banco BPM of Italy. The third candidate, which I predict may fail by August of 2017, is Societe Generale of France, named the Credit Derivatives House of the Year by Risk.net for actually doubling down and buying up four large international banks in Asia with billions in the now infamous credit default swaps market, or CDS market. All of these banks are globally interconnected and all have unbelievable levels of exposure to debt instruments such as sovereign bonds and loans, and to the about to implode derivatives market. This chart shows the U.S. global systematically important banks, or the major banks in the U.S., and their exposure to European debt. As you can see, the credit derivative sold is over $800 billion. This clearly demonstrates the connectedness of the major U.S. banks to the European debt load and the EU. So goes the EU, so goes the major U.S. banks. This third chart shows the top U.S. banks' derivatives exposure in the millions. Note Citigroup Incorporated, over $53 trillion of total derivatives exposure. The list is unbelievable. In total, it is $252 trillion in derivatives exposure by the top 25 U.S. banks. Prediction number 3. The euro and the European Union will disintegrate further. A forcing of distinct cultures under one banner and flag has never worked throughout history without violence and bloodshed. What makes you think this time will be any different? Since there has been no bloodshed in this union, at least of their own, there will be no lasting union. The Syrian and other Middle Eastern migrants are only adding fuel to a burning fire of disintegration. It will progressively get worse with each terrorist attack. Prediction number 4. Equities will crash many times. Within the next 6 to 18 months, there will be multiple flash crashes in the equities markets, leading to one big crash, which along with the derivatives implosion will take the entire financial system down. Real estate, equities, derivatives, paper assets, and bonds. Get out of paper. Prediction number 5. Gold, silver, and physical assets will explode. Within the next 6 to 18 months, physical gold and silver will begin their rise to unprecedented levels, and as Mike Maloney says, the greatest wealth transfer the world has ever seen will begin. Wealth will be flowing from equities, real estate, and the derivative and debt instruments into physical assets, the foremost being physical gold and silver. Any useful physical asset commodity will also thrive. This includes oil, food, farmland, skilled human labor. Things will realign. People will lose their jobs. Entire industries will shrink. Some will vanish altogether in certain regions and sectors. Those with physical gold and silver will become extremely wealthy. That is all for now. I hope you've enjoyed this first edition of the Champs Forecast newsletter. To subscribe, ask questions, or add commentary, please email thechampsforecast@gmail.com. I wish you happy hunting, stay hungry, and God bless. The Champ.